Welcome back to the National Real Estate Cafe with Don and Gino Fronti, just having some fun because we do this every day for you to let you know what's happening with your real estate market updates.
Somebody tell this guy to keep his day job and not be a singer, please. He's really good at numbers. Not so much singer.
Yeah, that's true. That's why that's why we do home loans.
Yeah.
But today we're going to go over lots of numbers, some very interesting numbers from MBA that you're going to want to check out. Let's pull up the chart here.
Yep. There's a lot of stuff to look at here, Don, and the number one thing to probably look at is GDP, right? We think that's a really important number going forward for our country. And this year we had a lot of instability with GDP. We had a lackluster number, then we had a gigantic number, then we had a lackluster number, and Q4 is projected to be fairly normal.
Right, so they're projecting that maybe 2016 they're hoping to be more normal, meaning 2.5% growth. Coincidentally, that kind of tracks consumer prices.
Yeah, so you got to look at consumer prices as inflationary, and again, we saw a horrible first quarter in 2015, from bust to boom in the second quarter, and then a little bit of deflationary towards the third and fourth quarter, which is why the Fed decided to keep interest rates low. However, next year it looks like it's going to be pretty stable, and we expect the Fed to raise rates.
Yeah, the Fed decides to raise rates basically once they hit at or above their targeted of 2% basically for appreciate consumer prices.
Yeah, and then the one thing that you want to look at here is inflation. That's the number. That's what you were trying to say. Yeah. But at the end of the day, you look at long-term rates are looking to go up as well. Now, long-term rates are not going up because the Fed raises rates. Long-term rates are going up because we expect the economy to continue to improve. Right. And as the economy improves, people are willing to take a little more risk because they're looking for a little more return on their investment.
So let's bring up the chart again. We'll go over some housing starts and see what they project, because there's a differences between the home price appreciation from FMHPI and versus Case-Shiller. But bottom line, both of them are seeing that we're going to see some strong housing starts are going up throughout all 2006. We've been warning you about that over and over and over. And you're going to see total home sales are going to continue to increase at a slow pace as well. And
appreciation also is considered that's going to be, both agree, even though they don't agree on the number, both agree that we're going to have appreciation in 15 and in 16, close to the 4% marker. And you can see on the chart at 4.9 and 4.3, 3.3 and 3.9. So many factors are going to be decided there, weather, rates, etc. But somewhere in that 4% region, and what's important about that is that the 4% region is the 50-year median appreciation range. So when you look at 4%, that's a very safe forecast. That's healthy appreciation. That's what we would like to see nationwide. And that's sustainable appreciation.
So hopefully you like the numbers that we saw, because what it does is shows a little bit of a consistency moving forward to 2016, which is perfect. Remember, we don't like booms and busts. Booms and busts are no good. That's what we all went through. We like steady improvement. It's controllable, it's predictable, and that's what we like.
Yep, so if you want more predictable information, check with us daily. You can do so by texting NREC to the number 58885, or if you're like me and you really like email, you could go to NREcafe.com and subscribe via email. And I was just about to say go to donandgino.com, which you should, because that's our hub. Everything that we do is there. We have almost over 1,000 interviews that we've done on donandgino.com.
That's right. So check us out and make sure you tune in daily.